Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Hi, everyone, and welcome to the Top 5 at 5. I think everybody's kind of getting to know what this is all about, which is we're going to try to bring you the top 5 best investment ideas from each of our guests. And today we are joined by Mike Simpson, who's a portfolio manager at NCM, part of Cumberland Investments, $4.1 billion in assets under management. And Mike focuses on dividend stocks, which I think, in this world of uncertainty, people still want to know that they're going to be getting their dividend checks in the mail. So, Mike, great to have you and to share your perspective with all of us today. So thanks for coming.
Thank you, Catherine. Great to be here.
Great. Why don't we first start, though, with kind of your top-down perspective? U.S. 10-year yield above that 2% mark. Markets are down today. They felt a little bit better at the beginning of the week. I mean, what's your view in terms of the overall picture here?
Yeah, view is that everyone knows we're coming through a once-in-a-century pandemic. So there was a lot of restrictions, a lot of demand that was stifled. So as a result, for the first time in my career, we're seeing issues with supply. Demand is still pretty good. Now, supply for a variety of things, from call it meat to semiconductors to other products, is in short supply. Recently, we've had some trade or traffic interruptions of our border, which is very important because Canada, as a small nation, trades a lot, and our biggest trading partner, as people should know, is the U.S. So the view is, my view is, we're coming out of the pandemic. We're going to need to rebuild inventories. We're going to watch to see how well those inventories are taken up later in the year. We all know where inflation is now. The key question is where inflation will be at the end of the year. We think it'll come down, but it may come down to levels that are much higher than we're used to. It may be down to the 3.5%, 4%, which is still quite high. So within the portfolios, we want to find companies that can raise price, and companies also that have good availability of workers and really have treated their workers well, so they're not constantly raising the wages of their labor force.
Mm-hmm. And when you do, though, look at the market and really see a lot of volatility, are you able to find some stocks that, and we're going to talk about them, that you feel really comfortable owning right now?
Yeah, it's a good question. So we're looking for at NCM companies that have pricing power, and also companies that can withstand some shocks, and companies that more or less treat their employees well, so they're not constantly finding or replacing them or scrambling to raise wages. But in this context, very much a stock picker's market. But I'm confident that I still am finding names, and I run a concentrated portfolio of 39, 40 names. So I don't have to own 150 names. I could just own what I feel are the 40 best names out there.
Yeah, that's nice to have a concentrated portfolio. It actually, to me, has always made a lot of sense. So let's go through a couple of your best ideas. What's number one on your list?
Sure. So we'll start in Canada. Transforce, it's been around a long time. They've grown rapidly over the years through acquisition. One of the biggest acquisitions last year was buying a division from UPS. LTL stands for less than truckload. So because UPS was just in the business of transporting full loads, this division was somewhat, call it, neglected. As a result, Transforce has the ability to realize some synergies, close some extra terminals, improve what's known as the operating ratio. So we like that as well. Transforce has the drivers. They treat the drivers well. They have unionized workers both in Canada and the US. And more importantly, as I was alluding to earlier, TransForce has the ability to raise rates. Earlier in the year, some analysts thought that the trucking cycle was over, but we still see strong demand for trucking services, and then pricing is still very good.
And what kind of dividend yield are we seeing on that stock today?
Well, TransForce has grown their dividend over many years, and because the price has gone up, I believe I'll just check to you. I think it's in the 2% range. It's actually a bit lower, 1%. But what's key is the dividend growth. TransForce has grown their dividend over the last 5 years at 11%. So, quite a healthy yield, and even with short rates going up, 11% compounding of your money, of your quarterly reward is quite good in our view.
And what's the valuation on that stock right now?
Yeah, it's a good point, because TransForce often gets comped against US companies like Old Dominion or Knight Swift. So TransForce trades at about 14 times earnings, whereas Old Dominion trades at about 22 times earnings and about 8 times enterprise value to EBITDA. And like I said, they have the ability to raise price. They have the ability to get more synergies and profit from the UPS acquisition. So we think TransForce stacks up quite well against the rails and against their US trucking peers.
Okay, great. Let's talk about another top stock for you on the dividend front. What would that be?
So I'll go to one that's not really well known. It's called Booz Allen Hamilton. They're a consulting firm. They get about 93% of their business from the US government. So think US Department of Defense, Homeland Securities, various other security agencies in the US. So they're very big in cyber, which is a key consideration these days. They have the ability to raise their dividend. They have it's mostly human capital, so they're good balance sheet. Debt to EBITDA is about 1.7 times. A decent dividend yield, and they have the ability to raise it. I'll just get you what their dividend yield is. Current dividend yield of about 2.36, but dividend growth is pretty good, and they also reward shareholders with share buybacks. So 5-year dividend growth rate is 19%. So very, very strong, a very good thing.
And what's the ticker there?
Ticker is BAH, Bob Allen Hamilton.
Okay.
And there were rumors that this company might be, acquired by another, but we're not buying it for the takeover possibility. If that happens, we don't know. That's great, but we're just buying it for the very steady recurring revenue. Also a good backlog, which I didn't talk about 27 billion. So, a good line in sight for work. Sometimes the analysts get hung up. The governments are sometimes take a little longer to pay, but a very solid company and been around since 1914.
Wow, my goodness. Okay. Before we go to the next couple of ideas, Mike, I just want to say as well, in a rising rate environment, dividend stocks tend not to perform as well because people can just put their money in a higher interest rate bearing product, like a bond. That's not happening exactly today. But they do get a bit of a knock. I'm personally not worried. I still want to buy my dividend stocks. I want to own them for the long term. But just maybe weigh in on that.
Sure, it's a good point. And we do know that rates are going to rise. I don't know any consensus forecaster who sees rates staying where they are but Ned Davis out of Florida did some very good research on dividend stocks. They're actually the best sector that performs well in a rising interest rate environment. So think some of the higher growth companies, the higher torque names that aren't profitable or just barely profitable, they will be hit the hardest. A good example in Canada was the former largest company in Canada, Shopify. From its peak, it's down more than 55%. So, that's just what Ned Davis research shows. So the ability, what we call it NCM, the dividend champions, that also offsets some of the rate increases. So, I'm talking to you about TransForce raising their dividend, Booz Allen Hamilton. I've got a few other names, but the rate of growth of dividends is important. And
Mhm.
also, we're going to watch the end of this year. How quickly will rates rise? So the market can be okay with rate rises in a steady, consistent way, but if they rise too sharply, then that's what could cause some concern or consternation among market participants.
Okay. Good to talk about that. Let's talk about a couple of other names as well. What else is on your radar?
Sure. So a company based out of Ottawa that just had their investor day called Calian Group. They're a conglomerate. They have different divisions. Advanced Technologies makes equipment for satellites, the antennas, and we know there's a lot of satellites being launched for communications and other purposes. They provide online learning. They also provide services to the military with regards to simulation. And another company that's big into software, cybersecurity software. So they recently bought a company in the US, Computex. It should close in March. So a company that started out small, grew their dividend. Last couple of years, as they're making acquisitions and paying down debt, the dividend didn't really grow all that well. But now they're a larger size, about 600 million market cap. They can resume their dividend growth, and they'll still make acquisitions. So the ticker is C Charlie George Yellow, trades on the Toronto Stock Exchange, and current dividend yield just about 2%.
And Mike, it's interesting to me. Like, I don't think a lot of people know of that name.
That's right. There are more analysts covering it, but because there's still a knock on companies that don't have one clear-cut division, call it, for lack of a better term, conglomerate. But with the exception of the manufacturing division, or Advanced Technologies, as Calian calls it, out in Saskatchewan, there are synergies between the different divisions, between the learning and the software, and the cyber. So not well known. There's a lot of indexers these days and a lot of passive indexers. So as Calian grows through acquisitions, they've proven very successful at making them and making them accretive. I have no doubt that they'll attract more notice. And it's to my advantage because I'm buying it before it gets well known.
Yeah, absolutely. So another one that you like, those Intact Financial. So one in the financial world as well.
That's right.
Yeah.
Yeah. So one of the best property and casualty insurers in Canada. About a year and a half ago, they made an acquisition of RSA. RSA was a European player. They primarily wanted the Canadian division, which they've got a dominant market share in Canada. But even with their dominant market share, they're only at about 22% market share. So they also, with that, received some European operations in England and Ireland, also Denmark, but they've sold their Denmark operations. So really good operators. During the pandemic, we were driving less. Good combined operating ratio, below 100%. They also have operations in the US. A couple of years ago, they made a small foray into what's known as specialty insurance, where the margins are higher. So there's still room to grow in Canada, as I said, because until you get to about 37, 38% market share, the regulators, they'll allow you to grow to acquire others. But recently raised their dividend by 10%. And going back to 2005, so I guess that's 16 years to 2021, they've compounded their dividend at 11%. So good balance sheets. They're studying climate change, how it affects insurance. I think the best management team in Canada when it comes to insurance. So I like this a lot, and it trades at a lower valuation than some of their US peers. And they, in my view, they can continue to grow, and they're a good company. They gave some of their commercial clients and some of the hardest hit industries, entertainment and restaurants, a break during the pandemic. So they should start to get some of those premiums back, which is really fantastic.
Yeah. And nice that they work together, because we heard so much about companies, not working together. We heard some that did, but to be fair. And let's take a look at your last top pick, which is Tidewater Midstream. TSM is the ticker. TWM. TWM.
Right. Yeah, so not well known. TWM, Joel, the CEO, works very well. So their base business is just providing midstream infrastructure. So think a company that's producing natural gas. Before that gas gets into a pipeline, it has to go to a plant, a facility, which is known as a midstream facility, to take out the impurities, any hydrogen or methane or sulfur, et cetera, et cetera. They also have a refinery in Prince George Refinery. So they're getting into renewables in a big way. There's incredible demand for renewable diesel. So their their refinery in Prince George can blend diesel with canola. So they get credits from the BC government. They're also into renewable hydrogen, and they're also into renewable natural gas. And they've spun out a subsidiary called Tidewater Renewables, which they own 68% of it. So this is an excellent company. It has a green angle, which is good. So with our existing carbon footprint, they're helping to green it in a variety of ways. As I said, the renewable diesel, natural gas, and hydrogen. So excellent company. And, as they pay down their debt, I could expect, future dividend increases or even at the current price levels, share buybacks. So I like this a lot, and it fits well into our theme of this is a commodity that should do well, and we're happy owning it.
And sorry, what's the dividend yield on it?
Dividend yield of Tidewater, I'll just check. I believe it's 3%,
Yeah.
but I'll just check for you.
Okay. And I guess, Mike, there's probably people wondering, 3%. Okay. There's probably people wondering like why, it's always interesting to learn about new ideas, right? Because there's a lot of people just talk about, the banks that we've heard about 1,000 times, but that's still valid. So I am going to ask you, like, what do you think about some of the REITs out there that are still offering a much higher yield?
Yeah, I mean, we do have exposure to REITs. Going into the pandemic, we wanted to have exposure to what we thought were the best. So we own Granite REIT, which has great exposure to industrial. Granite REIT, which part of it, they still have some legacy assets. Were Magna, who you're aware of, they had some real estate they spun out. So that was the genesis of Granite REIT, but Granite has expanded into the US and also Europe. Very solid management, solid balance sheet, low payout, and basically, however we emerge from the pandemic, we're still going to want to buy stuff at our convenience online. So the need for industrial space is quite high. And given how cities develop, there's a lack of industrial space. So this plays into what Granite does. And we've seen some of the private equity. Blackstone and others just buy huge portfolios. So I think this bodes well for Granite REIT. And, given their strong balance sheet, they don't have exposure to floating rate debt and low payout ratio. Any interest rate increases, which in my view won't be that large, they'll be able to withstand.
And just to kind of leave it off here with your outlook for interest rates. I mean, now I think everybody's assuming we're going to see it in the United States. Yeah. Originally, it was going to be 3 rates. Now I think people are talking about 5 rates. We'll see. BOC meets, I believe, on March the 2nd. Get ready for liftoff there in terms of raising the rates. What do you really think? I mean, it's hard to know for sure in terms of how many times they can actually raise rates, how many times they should raise rates. Hopefully, the central bankers around the world don't cause a recession. UK saw their highest inflation rate in 30 years the other day. So, I mean, how much of a risk is that as well in the equation? Or do you think it's just going to be a couple times, that's enough, and then we'll settle into it?
So that's a good question, and it's a key question because we've seen, as you pointed out, inflation rates high all over the world. Canada, fortunately, has an inflation rate slightly lower than the US. But on March 2nd, we believe the Bank of Canada will raise rates, in my view, 25 basis points. But once that happens, that's the start of a new cycle. So what's different this time, always dangerous words in the investment world, this time it's different. But there's a lot of debt that's been built up. So I think that may be an upper limit as to how far rates can go. But my thinking is at the end of the year, we could end at 1 or 1.25%. So if we end at 1.25%, I mean, that's basically where we were before the pandemic. So people or companies that are highly levered or companies that are exposed to floating rate debt and haven't done their homework, they're scrambling now. So at the end of the day, we will get some rates. It'll be interesting to see later in the year if there's greater labor force participation both in Canada and the US, and if inflation comes down. I'd like to be wrong in saying that we exit inflation at maybe 3%, but I'm a bit higher at 3.5 to 4.5. But we'll have to wait and see how that unfolds. And there's also macro events, which you're aware of, what Russia does with Ukraine or what China's intentions are with Taiwan. So we'll have to watch those. But more or less, we're going to see the economy unfold, and as we get into spring and warmer weather, we're going to see a normal decline in cases of respiratory disease, which happens. So I would expect that to happen too to the various variants or strains of Omicron, et cetera, et cetera. So, I'm optimistic about the spring and summer, and, hopefully things can get back, and, the supply chain can be normalized, although, the supply chain, they're doing their best, but demand doesn't remain strong. So supply chain will actually benefit from a little reduction in demand.
Mm-hmm. Absolutely. All right, Mike, we will leave it there. Thank you so much for joining us, your thoughts and your top 5. It's awesome.
Thanks, Catherine. Okay, take care. Bye-bye.